Hey there, everyone. Welcome to the Final Bar. It's Wednesday, August 7th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, coming to you today from Cleveland, Ohio. Great to be back in the Midwest. It's been some crazy weather here, some tornado activity, so excited to get back to the Pacific Northwest safely today here, and should be back and better than ever from Redmond, Washington with you for the show tomorrow. We're recording the show a little bit before the close, around 3:15 Eastern, just so you're aware. So we don't have the official close locked in just yet, but we certainly have seen a pretty dramatic rotation through the course of the day today. We're going to focus on what sort of additional evidence we've gathered just watching the market trade through the course of the day today here on Wednesday afternoon. We'll look at some of the individual stocks on the move, particularly around earnings. There are a couple names that did particularly well in the first half of the year that are showing quite a lot of weakness now in the latter half of the year. We'll talk about what that might mean for the broader market phases, as I would argue this corrective period is far from over. Let's get right to our market recap and look at how things played out. And again, we're not quite to the official close, but here around 3:15 Eastern, you can see the major averages opened a bit higher. So headlines earlier in the day from your favorite financial website were probably talking about this nice recovery day and how we're following through from yesterday's recovery, and maybe this is the end of the downtrend, et cetera, et cetera. But by 3 o'clock Eastern, feel like all those headlines sort of were edited to a little more measured tone. You can see the S&P and the NASDAQ both down. S&P about 1/3% lower, the NASDAQ about 0.5%. Again, through the sort of mid-late afternoon. Small caps not getting it done either. There's pretty much everything on the front page of our market dashboard in the red. You'll also notice the VIX moving slightly lower. Actually, it was a lot lower earlier in the day. Actually pushed back higher. I mean, look at the volatility in the VIX. There is a $ VVIX, I think, which is like the VIX of the VIX. Pretty choppy these days because you know there are quite a few swings here. Just in the last two trading sessions, we've gone from 22, or really from 33 down to 22, and now sort of in the middle of that range. So, basically the noise that we're observing here, is, from my interpretation, is part of a larger rotation to a higher volatility environment. Our friend Katie Stockton has been a frequent guest on the Final Bar and on StockCharts TV, wrote a great article for CNBC talking about that higher volatility regime and how that should be more of what we kind of expect. I would tend to agree. I think those are wise words. You can see interest rates overall moving higher through the course of the day as bonds have sold off the TLT as of now, and the bond markets are closed. The TLT did get down about 1%. You can see interest rates overall moving higher. The 10-year yield not quite above 4%, right around 3.97. The long bond yield just above 4.25%. You are seeing the short end of the curve, of course, start to come down as we're pricing in that first rate cut. And the market now pricing in a 50 basis point rate cut at the September meeting, which is about 5 weeks away from today, actually, as I look at the calendar. So overall, I would say the trend has been lower rates, stronger bond prices. I would still argue that is the larger, maybe the primary trend, as we would call it. In the short term, we're getting some mean reversion, just like we're getting a bounce in equity prices, getting a pop lower in bond prices, pop higher in interest rates. Gold and silver, gold essentially flat for the day, silver slightly lower, copper prices lower as well. The energy complex actually did quite well with crude oil over 3% higher today. The energy sector ended up being the top performer so far on the trading day. Cryptocurrencies mostly in the red. Bitcoin did get above 57,000 earlier in the day here Eastern time, currently trading right around 55,000. Looking at the 11 S&P sectors, you can see it's energy at the top of the list, currently up about 0.9%, followed by utilities and consumer staples. So again, I continue to see defensive sectors at the top of the list. We're looking a little bit about the relationship between offense, consumer discretionary, and defense, consumer staples. You may notice that has recently broken down, which I would argue probably one of my favorite signals indicating a rotation from optimism to pessimism, from offense to defense. On the bottom of the list, you can see sectors like healthcare and consumer discretionary actually moving lower by 1%. And again, not quite done with the day, but you get a sense of where we're at here. Looking at the Magnificent Seven and Friends, you can see Apple and Alphabet and Netflix all higher. On the downside, NVIDIA down another 3.5% or so. Tesla down over 3% as well. Here in the late afternoon of trading, we're going to look a little bit at NVIDIA, maybe Broadcom as well, as some examples of stocks really changing character here recently. Let's go to a daily chart of the S&P 500, just check in on where things are at. And again, still an active session, but you can see how we opened sort of mid-range or at the upper end of yesterday's range, but a nice open higher after yesterday's close. But currently we're trading below yesterday's close. So distribution through the course of the day today. People have called this a dead cat bounce. There are no hard and fast rules, to be clear with you, in my interpretation of what a dead cat bounce actually is. I've heard some people call it a dead cat bounce. I saw some comments of people saying it's obviously not a dead cat bounce because it's not X days or X weeks or whatever. These are just general guidelines, to be honest with you. In my interpretation, I'm a little looser with phrases like that. For me, a dead cat bounce is that general sense of a market going down, but you have a quick snapback rally to the upside. And the idea of a dead cat bounce is obviously it's going down, but it tends to bounce. That's a horror. I don't want to examine that analogy any further, but essentially it's when a market has a steep decline and then a sudden sort of V reaction back up. And when that happens, it usually implies that that's just the beginning of much further deterioration, right? And that's where the phrase comes from. The idea is that we're still going lower, and that is just a quick, inadvertent kind of natural reaction to a sudden downdraft and nothing more to be concluded. I'm continuing on the chart of the S&P. Now that we've broken all the other levels that we talked about, particularly that 5,400 level, I am keenly focused on 5,000 and sort of 5070. That would be the first Fibonacci support, also the 200-day moving average. Below there, 4,700. And if you ask me to say, Dave, where would you expect a major low in September, October? If I had to pick a level, which I don't like to do, I'd probably say 4,700. That would be about a 61.8% retracement. In my experience, that's a decent sort of downside objective given the rally that we experienced up until July and given the strength of that initial move lower and the deterioration in the other metrics that we talked about recently on the show. And again, my conversation with Mary Ellen McGonigal that we broadcast on Monday, that was from the Money Show end of last week. And over the weekend, I talked with Mary Ellen and others about just the general conditions. And we've all sort of noticed this, what I call change of character, all right? The market had a certain look and feel through mid-July. The market has a very different look and feel since mid-July, and particularly in the last 2 weeks, you've seen an even more exaggerated change of character as we've broken down and as indicators that still were showing quite a bit of strength are all of a sudden showing quite a bit of weakness. And I think that tells you a lot about what you need to know about the current market conditions here. Just to check in on a couple other charts to sort of finish thing off here, I would say the 10-year yield, obviously very important. We talk about a dead cat bounce. I think the chart of interest rates, particularly the 10-year yield, this is $TNX on our platform. You can see what I would argue what a dead cat bounce kind of looks like, right? A clear decline, or what's called a waterfall decline, right? It looks just like a waterfall, just accelerates to the downside. Clearly, bonds are having an exponential rise, bond prices, which means bond yields are coming down very, very quickly. And then you have this quick 2-day reaction off of the lows, and really started on Monday's session where we opened around 3.7% on the 10-year, got to around 3.8, yesterday to around 3.9. Today, we're pressing 4%. Before cooling off. That certainly feels like the impulse move, right? The main trend is down, what we call the primary trend, and this is a counter trend move, or a short-term rally against that longer-term trend, but the longer-term trend still remains lower. Now, the way that you can tell that that's not the case anymore is you see broader signs of accumulation. Indicators and a more trend-following indicator start to rotate higher. You put in a higher low, you re-engage above resistance levels and are able to gain some ground on the upside. And that certainly is a potential move for the 10-year yield, but I'm certainly not seeing it here today. All right, let's look at the volatility picture. As I mentioned, the VIX, of course, quite noisy. I'm just showing the VIX on a closing basis for simplicity, but given the volatility that we've had, I might just switch this, at least for the foreseeable future, to look more like this. So here we can see that we got all the way above 65, which is, again, the third highest value that we've seen in the last 20 years. And I did post a video on my YouTube channel called Market Misbehavior, where we talk a little bit about the message of the VIX and what other indicators can help validate that high volatility scenario. So check out that video if you haven't seen it yet. I would also mention that since that spike up to 65, the VIX did come all the way down and close the day below 40. And from there, we've actually gotten down to as low as 22, below settling into the current level around 27. I don't think we've settled in yet. I think the volatility of volatility is elevated, right? So even though the VIX is going up, the noise in the VIX, what we would call the VIX of the VIX, for lack of a better term, is also quite elevated. And I would tell you this is a very different environment than the slow and steady gainer of the first half of 2024. This spike in the VIX, that was the danger sign we were talking about, of that spike in volatility, which tells you people are getting nervous, people are getting fearful, and that's being reflected in how those index options are being traded. And that is exactly what I think we've observed here over the last week or so. And that is one of the things that gives me pretty good confidence that I think the corrective move probably not done yet. I want to show you this chart. I don't show this one too often, and maybe I should. This is my favorite measure of offense over defense. This idea was inspired from years ago, talking with Bill Doan, who was one of my predecessors as the head of technical research at Fidelity Investments. And Bill was active in the 1970s and 80s. He continued to publish into the 20-teens, to be honest with you. But back in the day, he was in charge of the market research department, as they called it. And we talked about looking at offense versus defense. Some of the tools that they used, the indexes and other things were expired, no longer existed. So, sort of thought around different ways to measure what we had been looking for, what they had been looking for back in the day, looking at offense versus defense. What I settled in on years ago was the equal weighted consumer discretionary and consumer staples indexes. The idea here is you want to measure when institutional investors are rotating to more of the offensive side or the defensive side of the consumer space. Because if you think of consumer discretionary, it's things you want, things you probably don't need, but it's kind of nice to have. Retail, travel, hotels, those sort of luxury goods, those are all consumer discretionary. Consumer staples are things you need, right? No matter what's happening with the economy, you still need alcohol, tobacco, toilet paper, personal products, cleaning products. These are things you need pretty much in any, maybe need is the wrong word, but you feel you need in any environment. And so things you want versus things you need is a great way of measuring just the spending power of consumers and how much they are willing to spend on discretionary purchases. So when the equal-weighted version breaks to a new 3-month low, as it did this week, as the cap-weighted version breaks to a new 3-month low, as it did this week, and indeed actually a 52-week low for the cap-weighted version, this tells me that the markets are rotating to much more of a risk-off positioning, and investors are rotating to the relative safety of consumer staples, which tend to be a little lower volatility, much higher yield, higher dividend component. So they tend to outperform and do better in a down market. Tends to be a safe haven if you're concerned about market stability or market performance. And so that breakdown in those ratios, I think, is a really telling perspective of how things have changed here, and really how the market is in a risk-off positioning, which is why I think astute investors should probably be thinking along those lines themselves. Let's finish off here talking about some names. And Peter Drucker had a famous quote, and I'll completely butcher it this way, something about the hero, the heroes in the previous bull market are always the villains in the next bear market, or something like that. His comment was the leaders, things that are doing so well, the super microcomputers, for example, making new, aggressive new all-time highs in the first quarter of 2024 after an exceptionally strong 2023. These types of names that are sort of the example stocks showing that particular theme, the rise in AI, the rise in technology, the dominance of this growth trade, these are often the stocks that get absolutely crushed in the bear market, and all of a sudden are recognized as being just the worst stocks ever because they were the problem. They were the ones that had the bubble, and now the bubble has burst. And I think it's worth noting SMCI certainly following through on Drucker's famous quote, breaking below the 200-day moving average here in the last week. Today, down another 20%. That's after being down, a ton. I'm not looking at actually I can use the inspect tool and tell you exactly how far we are off the all-time. There's the all-time high from February. We're currently down, about 60% off of the all-time high. That's a big move lower. And when people ask me about, risk management and using a percent stop, and why would you use a simple percent stop like an 8% or 10% stop? I think there are better ways to do it using volatility like average true range. I think there's some more nuanced ways of locking in your gains and measuring downside risk, or at least limiting downside risk. But the beauty of a simple percentage stop, like I'm going to sell 8% off of any high, is because all 60% losses start as 8% losses, right? That's how the math works. And so while they can gap down 60%, that's quite rare. Usually things gap lower or trade lower for quite a period of time before they've really had massive gains or massive losses. And one of the worst feelings as an investor is holding onto a stock that keeps declining and keeps declining, keeps crushing your returns, and you just keep holding it and trying to more and more to justify owning that position. That's actually a well-documented behavioral bias called the endowment bias or the endowment effect. So Google that if you're looking for what I mean by the endowment effect and how it can affect your returns. But in this case, SMCI really getting dinged pretty good. Airbnb is another one that, and again, not as much of a leading name in 2023, but certainly one that was breaking out in Q1. And I remember thinking about Airbnb right in March. And actually, when I think back of my special shows that I've done with Grace and Rose, we've talked about that particular phenomenon, right? And I think we actually talked about Airbnb, at least in one of those sessions in February or March, probably, or maybe even in April, talking about this, renewed uptrend and the renewed strength that we saw from Airbnb. Now, what we don't track after those episodes, we do personally, we didn't share with you, is that, of course, you're always looking at potential risk. You're looking to see if that trend continues and look at all the signs before today's 15% gap lower that Airbnb was starting to struggle. You had the big gap down in May. While we held the 200-day moving average, we then didn't. And here around 140, like if you're still holding Airbnb at this particular moment, I think you're ignoring all the technical evidence that points to a rotation from an accumulation phase to a distribution phase. So today's gap lower is certainly painful if you own Airbnb. My question to you, why would you still own it up until yesterday when we are in a clear pattern of distribution? These are the types of names that I think you avoid. I think you wait for signs of accumulation. I haven't seen any of that, or certainly not enough of that before this week. So further deterioration there. When you look at our market carpet, which again, I've come to really appreciate, some of the names that are really doing quite well here so far today are in green, right? So something like an Enphase Energy, something like Global Payments, GPN, VF Corp, or MGM in the consumer discretionary sector. But I'm going to point out Broadcom and NVIDIA, two of the biggest names in the brightest red. Let's look at each of these very quickly and talk about the technical configuration. So NVIDIA, I've had a lot of questions about NVIDIA. Is that the bottom? Was that the bottom? What about this? What about this? And my comments on anything like NVIDIA, same with Salesforce.com, CRM, or any of those charts that have been going down over the last 6 to 8 weeks. They're in a downtrend, right? As clarified by the fact that we keep making lower highs and lower lows. Get interested in a chart like this. In my estimation, the goal is to be getting interested once you no longer see signs of distribution. I'm seeing clear signs of distribution on the chart of NVIDIA, and I would say the 200-day moving average, currently around $81, lines up very well with the April low. I'd be interested to see if we find support at sort of that confluence zone around 75 to 80. That might be the downside objective I would keep in mind, or a potential downside target. But the problem with NVIDIA is the problem with Broadcom, which is for the last 6 weeks. This is a chart making a very clearly defined pattern of lower highs and lower lows. Now, Broadcom's a little different in that it is right at its 200-day moving average and is not broken below it. And it indeed has not been trading below its 200-day moving average since the end of 2023. So it's been quite some time, about a year and a half plus, that we've been above an upward sloping 200-day moving average. If that would change here in the week to come, I think that tells you a lot about the change of character on a chart like Broadcom. So some key semiconductor stocks, I would argue the charts are still weak. You could look for and potential areas of support. The 200-day moving average here, maybe the $120 support level from February, March, April. But in terms of trend, the short-term trend especially remains quite weak, and I would be interested when those trends stop going down. In terms of other names, sort of on the move and in the news, some things bouncing higher I wanted to let you know about. Shopify, also in the technology sector, nice gap higher. Now, we had a bit of a shooting star candle so far. It's not quite closed. We're currently around 3:30 p.m. Eastern, but I'm concerned that we have a higher open, a much higher trade, and then a close or current trading back at the lows of the day. The 200-day moving average, previous resistance right at today's high. So it certainly is giving the signs that traders are selling when we reach that previous level of resistance, which implies to me that's probably a good resistance level to continue to highlight. GPN is a nice bounce higher today. It is not yet eclipsed its previous swing high from July. So I think this chart above 105 would indicate exiting this consolidation zone and maybe a new swing trend. I like the fact that we bounced off of support here from the June low, which also lines up from the late 22 and early 23 low. So there's some, really interesting support there. This is the kind of time when I was told, when in doubt, zoom out, right? Zoom out to the weekly chart, and you can see how important this sort of 90 to 95 range has been. There have been so many times, you can go back to 2018, where we find support right at this range. So I don't have a problem with, as a long-term play, buying in on the weakness here and seeing if we can get a return at least back into the range that we experienced. But in terms of the short-term trend, I would say still more to prove on a chart like GPN. Pro tip, I would be watching the weekly PPO, and that gives a buy signal that often can be a great tradable low after a key support level. Some other stocks continuing to have a seat on the struggle bus. Disney going in a downtrend. Again, I'm thinking about some of these charts like NVIDIA and Broadcom. If those could continue down for a couple more months, it would look a lot like the chart of Disney. That's why I avoid things in a primary downtrend, because primary downtrends I consider guilty until proven innocent. Disney with earnings before the open today, down another 4+% today, making a new swing low here, continuing to struggle. Again, I think that's a good chart when we find signs of support. Full disclosure, I actually do own some Disney in a long-term account, but overall in the short term, I think still quite concerning. Lyft is another one. It makes me think of the GPN chart, at a long-term support level, which could be an interesting area to think about it. But overall, just a waterfall decline continuing to accelerate to the downside. So Lyft continuing to struggle quite a bit. I'll leave you with Amgen. I think the concern I have for the chart of Amgen is not just that we've broken below the 50-day moving average, which we did today, and I would want to see if we get follow through Thursday and Friday. Do we see further distribution after that point? I would say that just a couple weeks ago, this looked like a great chart, and it looked like part of that resurgence that we've observed in the healthcare sector. Names like Amgen making a new 52-week high, breaking above a well-documented resistance level. Look at that shooting star candle, what Martin Pring would call it, Pinocchio bar, right as we tested previous resistance from January, February, and from May. And then we finally broke above there, but now we've broken back below that resistance. That's why those breakout levels, I like to keep on the chart just to see if we can hold them, because if we don't hold a breakout level a little later, a lot of times that can tell you the breakout was kind of a false one. Now we're showing weakness. Now the RSI is getting below 40, which is more weakness over strength, and I think continue to be concerned for a chart like Amgen, especially after today, down over 5% and down below a key level of resistance, now no longer serving as support. Folks, that's a wrap for today. I want to thank you so much for joining us every weekday after the close. Again, hopefully we safely travel back to Seattle. We'll be back in Redmond, Washington tomorrow. But in the meantime, be well, stay safe, have a great night.